What is a basic tax plan? Hi, I'm Scott Hamilton, certified financial planner, fee only, fiduciary with offices here in Austin and in Houston. We help people retire tax efficiently. So, what is a basic tax plan? Well, it's simply part of your overall financial plan, which we did a video a while back talking about your basic financial plan. Make sure you've looked at that and you've accomplished all those, out of debt, and all these. Then once you've accomplished those, let's move on to the tax plan, right? So the goal of the financial tax plan, the basic tax plan, is to reduce and optimize your lifetime taxes that you pay. Pretty straightforward, right? We need to be aware of it, and we need to be able to measure it, and we need to consider minimizing it. Everyone pays taxes. More taxes means you're doing well. So that's not a bad thing. It's congratulations to you. A lot of people believe it's patriotic to pay taxes. But we don't need to pay more than our legal share. So just don't give the IRS a tip, which is a common phrase that we hear a lot. Don't give a tip. Our goal is to minimize taxes legally. Okay. Don't let the tax decisions drive your business, the way you operate. Taxes don't let the tail wag the dog. So taxes is a component, but it shouldn't be the driving factor. Okay, so there's several options available of how to manage your taxes. Number one, if you're employed, you can a lot of times make a 401k contribution. At that point, you get a deduction. If your employer doesn't offer a 401k, you can set up an IRA or a SEP, and you can make your own contributions to your own retirement plan and get a deduction there, right? So that's number one. That's the quick, easy way, right? Now, second one is where you live matters. There are high tax states, low tax states. Be aware. Do the math. Be factual. Understand what the costs to live in a given state are. It's just different. Don't forget about state income taxes. Some have them, some don't. Property taxes at the state level, a state tax at the state level, and local taxes. All that comes into play. So be aware of where you live, how much you're paying in local state tax. Okay. Another option, number three, is a donor advised fund. You can set these up at Fidelity or Schwab, and it's a low cost structure where you can gift money to it. Maybe in your 20s, 30s, by the time you retire, you'll have a fairly nice nest egg there of money that you can gift out charitably. You have to be charitably inclined to do this, but donor advised fund, there's some real benefits there from a tax perspective. QCDs, qualified charitable donations. This doesn't come into play until your RMD, required minimum distribution age. I believe it's 72. But then you can just give a QCD to your favorite charity and not have to pay RMDs to the federal government. So that's a much better strategy. I've got clients that will combine a DAF with QCDs and combined with some of these other techniques, and it's a great way to minimize your overall taxes paid to the IRS. A third one, or the next one, would be home ownership. So you get a mortgage deduction. Now, I understand not everybody can use standard. The standard deduction has been raised so high, most people don't itemize anymore. But if you do itemize, that's a key component. Also, don't forget the home ownership. If you live in a place, you and a spouse, and then you sell that over time, right? There's a $250,000 per person capital gains just deduction right there. So $500,000 can be sheltered. So that's $500,000 of taxable income that you're not paying in tax. Huge, right? Home ownership is a big one. Roth conversions, this is a common technique. People retire, they end up with a lot of money in their qualified 401k IRAs, and then we want to move it over to an after-tax Roth account. So generally after they retire, the 7 years before RMDs, we'll do Roth conversions. That's a great way to move money from an IRA into a after-tax account. Yes, there is current taxes due, but depending upon how long you live and your goals, A lot of times that's a really nice solution. And also, don't forget about this. It's a gift of the IRS code, but at passing, the assets held by that person get stepped up in cost basis to the day of death. So if you have some individual or equity or investment or mutual funds or ETFs, those funds will get marked up to the date of death. And that's an important tax saving. So don't forget about the stepped up basis. So together, combined with this, you can work on what your tax strategy is, your tax plan. There's a lot of very advanced techniques with this, but for a basic tax plan, this covers the bulk of them. Thank you for taking the time to watch. Please like, subscribe, visit our website, Hamilton Financial Planning, and thank you for taking the time to watch. Appreciate it. Thank you.